You might see a breakout that don't hold. You might follow flows you can't control. Jim says that's just convexity. And the VIX begins to roll, burning down the forget your...
I realized only like 3/4 of the way through that song that it was created by robots. I got to tip my hat to the robots. They did a good job.
I think those moves are all Jim. I think
he was dancing. That was real stuff.
That was real.
Those are my real shoulders too, by the way.
Welcome back, everybody, to the Weekend Rip. It's me, Ben. Got Emil here, and our favorite guest, as always, Cem Karsan from Kai Wealth Advisors. How you doing?
Cheers. Good. Happy Friday.
Yeah.
Do we have anything funny on the mug, or is it just a classic mug?
Well, actually, there's a little something. This is from Reykjavik, but what you'll notice is it's a distribution that is very, very steep.
All right.
And there's a fat left tail and a fat right tail.
Yeah.
It's leptokurtic, if you will.
I knew we could count on you for something.
Yeah.
I also have a shirt here you may want to see, which is a
Summer of
George shirt.
We love the Summer of George. The Summer of George continues with the Qs barely up 1.3% on the week. The SPY's up just under 0.75% on the week. Bitcoin down 1.2%. No doubt due to that huge shout out to that whale. Jim, did you see that whale finally liquidated 80,000 Bitcoin?
Yeah, pretty impressive. Like that they held out.
Ali, that guy's having such a good weekend. I can't even imagine.
Oh, it's just getting started for him.
Oh my God, or her. Could be a.
True. That was. Sorry.
Yeah, it could be anybody. And the VIX is, as we say, is taking a ride on the Lolita Express with Jeffrey Epstein's ghost, because it is 16 and a half, and is giving foot rubs to Jeff Epstein's ghost. And anyway, so thank you for the laughing. Yeah, we got that Summer of George, the wet hot American melt up. It's just continuing. It is never relenting, and we've got this special "Stop Making Sense" edition. If you caught the intro there in the thumbnail, because it's what's the name of the band? Talking Heads.
Talking Heads.
Because none of this makes sense, but Jem is here to help us understand what is going on in this market. Because even though my account is at all-time highs. Thank you very much. I hear the applause everywhere. I still don't get it, and it makes me feel like a bit of a fraud because it's like everybody's a genius. Jim, are you a panikin?
Panikin? I'm not sure what that is. What's a panikin?
Oh, you missed the whole Panikin thing?
Oh my God, good for you.
Trump has a whole party just for you. When the whole tariffs thing was going on, he was calling people panikins for panicking and selling and.
I am not a panikin,
but he's having a nice victory lap right now because he gets to do all these memes about the people who panicked.
Yeah.
Yeah, I mean, it's good to be president of the United States and control the Treasury and eventually the Federal Reserve. It makes you a good trader. You know, it's weird how that works. You trade well. He told you to buy the dip.
He truly did. Oh my God.
I mean, he did give everyone a nice tip. You have to give it to him.
You got to listen to the president of the United States when he says stuff like that.
Yeah.
Well, we had banks reporting strong earnings this week. Pretty much everybody. JP Morgan, Citigroup, Wells Fargo, Bank of America, Morgan Stanley, Goldman Sachs, all reported strong Q2 earnings. They had, no surprise, elevated trading revenues and robust consumer banking performance. I'm a robust consumer. I'm so robust. Yeah, I'm as robust as they come, actually. I'm robusting out of this damn shirt. But then we had an elevated CPI, which was surprising, and I would have thought that it would have caused a little bit of a drop, but lo and behold, doesn't matter. Inflation came in at 2.7%, and all the basic necessities, utility gas, car insurance, electricity, meat and eggs, car repair, homeowner, hospital services, rent, food away from home inflation, the old Taco Bell indicator, all up. What sense is there to make of that, Jim? That inflation's just the market just not give a crap anymore?
We've said this before. In the short term, markets are a voting machine. In the short term, all that matters is buyers versus sellers, and a lot of the structural things that drive buying and selling have nothing to do with logic. And actually, And we'll get to this. And I think in the words of George Costanza, if everything I've ever done wrong is I should do the opposite. That's what I'm going to do. I'm going to do the opposite. And what happens during the summer of George is vol compression with little to no volume, a dispersion of the constituents of the index. And if you're going to push things away from each other and there's nothing going on, guess what's likely to happen? Those that are short are likely to have their shorts go higher, and those that are long are likely to see their longs go lower. And those that are long and short, like hedge funds, are likely to see both go in the opposite direction. It is a pain trade. And almost by definition, they are short things because they deserve to be short logically, and they are long things because they deserve to be long logically, yet they are all positioned logically in a way that is getting hurt. So the running of the memes happens in the summer. Retail wins, institutions lose, but not because retail is right, because the positioning at the institutional level is so big and there's so little volume, and dispersion pushes everything away from each other. So the answer, quite frankly, is to do the opposite, is to do the things that don't make sense, that are illogical, to fight the positioning, to squeeze the positioning. And again, positioning by definition is there because, generally speaking, it makes sense. Ironically, that intro that you have is very much at the core of what's happening this summer and what's driving a lot of the movement.
Interesting. Yeah, we've had, I want to get into what you mean by all of that. I fully understand it, but some of our viewers have requested some like vocabulary lessons. We'll get to that. But one of the other big things that's happened this week is Trump and his cohorts absolutely dragging Jerome Powell through the mud and suggesting that he could be fired, which we all know can't happen, apparently. But in this regime, anything can happen.
Trump makes things that can't happen all the time.
That is very true.
So,
but Deutsche Bank just came out and said that they consider the removal of Powell as one of the largest underpriced event risks. And you had, I can't remember the guy's name. I love him so much. The Bond King. He's a maniac. He was on your show talking about how it would really be bad.
Oh, are you talking Rick Santelli?
Yeah. Thank you. Him.
Rick's the man.
So yeah, why would that be a bad thing?
So to start at the beginning, you have to understand Trump cannot replace Powell until June, which he'll automatically be replaced. He could on the grounds of cause or fraud, which they're trying to make a case for, but it's really a narrative. The best thing that could happen is that he could get the people and the markets to believe his threat of doing it. Because if he does, then markets will be supported. The 10-year yield will be for a bit, held in check. The Fed's powers of projecting policy are its most powerful powers. Right? It's not actually moving the interest rate itself. It's projecting what they're going to do and moving the interest rates on the curve accordingly. That's what he's doing. That's what Trump is doing. He is projecting policy. He is essentially doing what a shadow Fed would do without putting a shadow Fed in. And by the way, that's the best thing. If he actually did replace Powell, that would be bad. The 10-year, by the way, if you watch what happened to the 10-year, it did not like the first kind of, is he actually going to do it? So there is this, actually, if he does it, that would have some disturbing effects, A. And B, I want to make a point. I think the market believes more that he can affect interest rate policy by doing that. What do you think all the Fed governors would do if he fired Powell? Do you think they'd be happy with Trump? Do you think they'd fall into line with the new chairman? No, you would have a situation where, if anything, they would be more likely to try and claim their independence and stick to their guns. Replacing the chair does not allow you to just move interest rate policy. I want to be clear. This is Trump being Trump and trying to create a confusion and control as much as he can in terms of narrative to push outcomes. It is not actually about replacing the Fed.
I would love to see a mini January 6th just with the Fed board, the Board of Governors, storming the I don't even know what they would be storming.
Is Mike Pence still in danger in this situation?
Mike Pence is very much. He's always going to be in danger.
He's going, oh, not again.
Yeah. Speaking of Trump, I mean, it was a big week for crypto, not only because of that whale, as we mentioned earlier, but there was this new legislation passed in Congress that's apparently incredibly bullish for the industry. With I know that one of the big headlines was he's pushing to allow crypto in retirement portfolios, and it pushed, and then there was another thing with stable coins that I still don't fully understand. But then we had tariff letters going out, and of course the big Epstein situation. It's really interesting to see Teflon Don just continue to have all of these things.
Yeah, I mean, now he's kind of going to war with his base a little bit.
Yeah.
Calling them all losers if they're still believing in this.
Well, they are losers.
Sure. But yes, it's the first time he seems to be like actively going against them.
Yeah. Yeah, it's God. And so all these things with like him talking about Powell always feel like some kind of distraction.
Yeah, that's definitely a big part of it. The Epstein thing is it's a problem that's not going away. Why? Because at the core of it is about the whole point of Trump's resurgence is the kind of burn government down, like to be unconventional, to try and change and drive something that will change the way this has happened, how inequality is spread, et cetera. And so the second he starts to do what everybody else has done in terms of covering things up, in terms of hiding things away, the whole idea of draining the swamp comes into question, right? And that's a big deal.
Well, so let's move on to the. You had mentioned before the show that you wanted to talk hedge funds, and we've got here that global fund managers are rushing into equities at a record pace. Cash allocation has dropped to 3.9%, the second lowest in 12 years, according to a B of A survey of 175 participants with $434 billion in assets. So what's going on here?
Those are not hedge fund assets. Those are long, generally long assets, et cetera. So yes, and if you look at retail and you look at mom and pop, they're at the highest allocation they've ever been at, which is about 49% of all assets are now in equities, which is a crazy number. Just to give you a sense, that number was in the low 30s a decade or so, ago. So we are, right at record valuations and several metrics. You can go whether it's, the Schiller, CAPE, or whether you're at Warren Buffett's favorite GDP over, I think, well, what is it? Debt over debt. Those two in particular get you to a point where you're really you got to be questioning where things are on a macro basis. Now, we could have said the same things in '99, and the market rallied for another year before it topped. So, are you going to get a blow off top? Is the real question in our view, and that could very well happen. We can get into that here in a little bit. That is probably one of two ways these things end historically. But I do feel strongly that we're in some type of topping process, and I've said that for a while now. I've been through the 99, 2000 topping process. I've been through the 07, 08 topping process. Looked at a lot of history and know how those things tend to work and why. This is checking all the boxes. Now the question is, will this end from here or 50% higher? And we can talk to kind of, or 30% higher. We can talk about that and really kind of get under the numbers and kind of what's happening and why. But yeah, that's the reality. And so let's talk about what's happening this summer though. And I think this is so important because this time is, it's not just the summer of George, and we'll get into kind of that dynamic, but it's how much certain areas of the market have grown in the last several years and how much influence they're having on the big picture and what those dynamics are causing. And we're getting almost an identical set of circumstances as last summer, largely because of these dynamics. And let me get into kind of what that is. at the core, we have rising interest rates, right? That we've seen happening for some time, and inability for them to come back down, and a fear, understandably so, that there's a high probability that global interest rates remain here or go higher. Given valuations, that's a big problem. I want to be clear. The most important thing in finance, period, the valuation of all assets, except for arguably Bitcoin and gold or something along those lines, is the discount rate. It's the long-term interest rate. We've talked about this before. 1968 at 20% interest rates. 1982 at 20% interest rates, the price to earnings ratio of the S&P 500 was 4.5. Why 4.5? Because that's a 22% yield, right? And the long-term, you're not going to buy the S&P 500 anything less than a 20% yield if you can get a long-term, bond from the U.S. government for 20%. Makes sense, right? And 68, very similar, 5% interest rate, about a 20 PE, which is a 5% earnings yield. Again, those two are in line. Guess where we are? 4.5%, 10-year, and about a 22 PE, 23 PE. Again, those things aren't coincidences. Everybody thinks it's all about earnings. It's all about the strength of the economy. No, it's about the 10-year. Earnings matter secondarily, tertiarily, but the most important thing is that long-term bond. So as that bond's gone up,
just real fast. So it's because there is an alternative to equities.
Remember Tina? There is no alternative. Yeah.
Because interest rates were pretty much zero. Yeah. So in this case, it's harmful to equities because suddenly stocks have a competition, right?
Yeah, and the supply and demand answer is that absolutely. But from a more kind of theoretical perspective, why in the world would you ever invest in an income stream, even, right? Any business? Why would you start any business that makes 5% a year if you could make 7% a year for free? The value of money and the appreciation of money, the inflation, whatever you want to look at, right, is core to whether you're going to invest or not. And it's also the liquidity. It is the amount of money that exists out there that's being borrowed. If interest rates are zero, everybody can borrow an infinite amount of money. If interest rates go to 7, that's the whole role of the Fed, right? People are going to borrow less money because there are less things that make 7% a year. And so those two things are intrinsically tied. Again, it's finance 101, honestly. People learn it and then it goes out the ear and then everybody starts talking about what did Trump say and whatever happened. What's the 10-year doing? So that's so critical. When institutions and entities start to see the risks of the higher interest rate, which is obviously bad for long-term bonds, as well as bad for equities and real estate and anything else that has an earnings yield. The risks, and you can see this historically, if you look at 125 years of market history, the periods where interest rates go higher, you have decades where money, in real terms, that you lose money. 1968 to 82, example we talked about, you lost 2/3 of your money in the S&P 500 if you invested over that 14-year period. Didn't go sideways. In real terms, you lost 2/3 of your money. And then, 1929 to 1949, 20-year period, right? Same thing. You lost a significant amount of your money over 20 years. There's many others in there. Actually, ironically, in real terms, inflation adjusted, 60-40. If you take the decades where money is not made and you put them all together, it makes up 70 of the 125 years. So 55 years are the actual periods where the S&P makes money. And it makes a lot of money when it happens. And guess what? 30 of those 40 years happened in the last 40 years. So yeah, it's awesome, right? No, but this is the point. And this is not to scare people but to realize that 60-40, that passive investing did not exist until the late 1980s. This idea of low cost, buy and hold investing, diversify with bonds versus your stock and buy and hold. That idea came about in the late 1980s. But I want to be clear, it's not a new technology. The Dow Jones Industrial Average was created 125 years ago. Indexing as an idea has existed for 125 years. Why the hell didn't we start passively investing until 40 years ago? Not a new idea. It didn't work before that. It literally didn't work for 85 years until 40 years ago. And why did it work? What happened the last 40 years? Interest rates went from 20% to zero. All right. So this idea is not a new idea. It's important. This is what Schiller talks about in his CAPE ratio. He does a 10-year interest rate adjustment for price to earnings, and he looks at it. There's tons of history and data. The Fed knows it. The Treasury knows it. What's happening? Institutions, which have been largely 60-40 for the last 30 years, 40 years, are starting to try and move to more non-correlated. They're moving to gold and Bitcoin, but they're also moving to non-correlated assets. And so hedge fund assets have gone from 2.5 million, just 3 years, 2.5 trillion, I apologize, lost a couple zeros there, just 3 years ago, to $4 trillion in 3 years. By the way, it was not pretty stable and just slowly growing before that. What's happened to the structured products, which again, non-correlated structures that allow people to make money regardless of whether the market goes up or down, or more non-correlated that tend to, by the way, sell vol. That's gone from 500 billion to 1.5 trillion.
Okay,
in the United States.
Right there.
Yes.
You just said a big thing. Structured products
Yes.
that have basically tripled in the last few years.
That's
Correct
the
me if I'm
annual
wrong.
issuance, by the way,
Yeah.
of those structured products.
Structured products are basically things that hedge funds offer to their clients as a way to
Banks
No.
offer.
Banks offer.
So hedge funds, you can invest in a hedge fund. Hedge fund does non-correlated trading with leverage. We get into what a multi-strategy hedge fund does. Actually, it's an interesting, there's an easy way to simplify that. We can get to that. But structured products are simply kind of options-like structures, right, that are packaged. They're not sold as options, but they basically say, hey, if the S&P doesn't lose more than 20%, right, in the next year, and it stays below a 20% gain for the next year, you will have a 5% yield on top of whatever the S&P 500 pays.
Ooh, on top of it.
So
Damn,
if the
that
S&P
sounds
goes
like a
up
big deal.
20, you make 25%. If it goes up 15, you make 20. If it goes down 5, you make 0. And so I'm just giving you, there's a million examples, but all that is selling a strangle, right? Or a one-touch strangle versus, you're limiting your upside. These are option structures that are just paired. Now, these things aren't very interesting, right? If you only can make 5% in a market, the reason you can make that, by the way, is there's a cash yield that you can make from the efficiency of capital here as well. So as interest rates go up, you make that yield and you get some yield of a structured product. There's a much better set of outcomes when interest rates are higher for these entities or these structures. On top of that, the value proposition is more appealing when interest rates are higher, as we were talking about. People want more non-correlated as well. So all of this is driving a desire for more non-correlated, but also more appealing returns from this asset class. And again, there's all kinds of structures there that can be structured through options that are more non-correlated that are appealing to people as an alternative.
So it sounds like we don't need to fully understand what these structured products are. It's more just the general idea is these banks, to satisfy their clients, to satisfy their customers, and to stay competitive, are saying, hey, we're going to get you even more yield for your bang for your buck by offering these anywhere from very simple to very complex option strategies that just are a way to milk just a little bit more from the fucking teat of the market. Am I right?
Yeah, they're not being more competitive to issue it. Like the banks love these, by the way, because they get to charge high fees on them. They're very lucrative. They get to hedge them in the marketplace, and they may not get exact hedges on the structures, but they're very close. So they take off their risk. They charge a big fee, and they sell these things. This has been a huge market, a huge and growing market. It's actually one of the biggest way people invest in Korea and Japan. Retail doesn't buy a lot of stock there. They do a ton of auto callables and all kinds of other structures. You can buy these structured products at the corner store, right? And if you think about it, it's kind of like a parlay or something. You can say, oh, if this and this don't happen, then you get this payout, right? There are all different ways to structure all kinds of non-correlated bets in the world. If you go to Vegas, you don't have to bet long something or short something. You could bet in any different direction you want. And if you like this bet and you like this bet, you can have a bunch of non-correlated structures. They're actually useful. If the fees weren't so damn high, it makes a lot of sense. But there are certain scenarios where the volatility is higher or the outcomes for 60-40 investing are not as good. And this is a combination of both that is driving investors to a much more competitive landscape for these products. And I want to be clear to put the numbers in perspective. Equities are about $200 trillion globally, or 120 trillion plus things that are tied to equities, about $200 trillion. Bonds are another 150 to 200 trillion dollars. So we're talking about something that's gone from 500 billion, right, to 1.5 trillion. It is still very small tied to 60-40, but because they're option structures and they have notional leverage and they have a bigger effect on volatility, also because they're issued annually, most of equities and bonds are held and not traded, right? The daily amount that moves the stock market incrementally is about $100 billion, despite it being a $100 trillion to $200 trillion market. But these are traded annually, roll over. They have a bigger effect than their size. A and B, they're so focused on they have notional leverage, and they have so much focus in the vol space that it really drives big outcomes. So anyway, structured product growth is dramatic, is the point. It's tripled in 3 years. Hedge fund assets, which again, to put those in perspective, 2.6 trillion, right, went to 4 trillion. Okay, so dramatic increases. But these two things are growing at the same time dramatically in just several years, right? And you could argue that they're really just starting to grow, that it's going to continue to grow in this way as long as interest rates are a threat, given the macro stuff that we talked about. By the way, we've been talking about this for 5 years, these outcomes. This is just the beginning. But as those things happen, the market certain dynamics are changing dramatically. The biggest portion of hedge fund assets, multi-strategy hedge funds like Millennium and Citadel and Point72 and Balyasny, we go through all the names, right? The biggest portion of that, about 27% of hedge fund strategies are long, short equity.
What does that mean?
That means what they do. So if you think about what hedge funds are doing, they're trying to get non-correlated yield. They're doing a bunch of different strategies in non-correlated ways. And if I make 5% here and 5% here, and those two things are non-correlated, I can make a bunch of yield. And then if I can apply leverage, now I can, on a risk-adjusted basis, start really making great returns. Long short equity is a very scalable strategy. All it is selling what's expensive, buying what's cheap, trying to go factor neutral, right? And there's models that allow long short equity managers to go factor neutral. So a Bera factor, which you may or may not have heard of, you can Google it. These are break up every equity into their underlying factors. Think momentum, growth, value, large cap, small cap, industry group, go through all the different factors. Even hedge fund positioning is a factor, right? But point is they can factorize all the equities, and then they can try and neutralize their exposure to all these factors, right? And then by doing that and modeling what's cheap and what's expensive, they get a residual value that is not explained, which is this is cheap or expensive relative to how it relates to everything else in the universe of equities. It's essentially a market making for equities. Now, when you're a long short equity hedge fund, you're not doing this 1x your capital, right? You may have $1 billion, but your exposure is $3 billion or $4 billion, right? Because you're net neutral. You're not long or short the market. You're not long or short. You're factor neutral. You can take more risk, right? In terms of gross exposure. Their net exposure is very low, but their gross exposure is quite high. And so when I say 27% of $4 trillion, so approximately $1 trillion is long short equity now, the exposure of long short equity is probably closer to 4 trillion because its gross exposure is what matters. And it's grown so much, and all these long short equity managers tend to come from the same shops. They come to learn from each other. They roll out, have their own fund. They use the same Bera factor models. They try and be unique, and these are bright individuals. They're really trying to think about things differently. But the reality is they have the same core education. They have the same core models. And as much as they try and avoid being in the same positions as everybody else, and they realize that that's a factor as well, they have logic. And this is where do the opposite comes from, right? Everybody thinks, it's very hard to do the exact opposite of what you think is logical. And the second we start going into this world where the logical thing is to do the opposite of logic, that starts to really be an issue for long-short equity and residual values. But the reality is hedge fund positioning tends to be correlated in the long-short equity space, in all spaces and everything. And long-short equity space has gotten so big that correlated positioning, particularly when all of a sudden volumes drop and there's very little liquidity to get out, and you have this dynamic, which is important, which is coming from structured products. Structured products tend to be sellers of implied volatility. They tend to collect option premiums, right? And the more structured product issuance comes in, the more banks have to offset that risk by selling vol.
Okay, wait.
Yeah.
I got to stop you there.
Please do.
What is vol selling? Because
Great question.
I basically understand it.
Selling options. Selling options is vol selling. Okay.
Right.
So if you sell options or insurance, that's what an option is. You have upside insurance, which are calls. You have downside insurance, which are puts. Right. You are selling options. You are selling premium. You are selling optionality. You're selling insurance. Right. To kind of put this in perspective, most of and by the way, an option represents an insurance represents a point on a distribution, a node, right? Like I'm going to bet on if the market goes down below 10%, then I want to be protected. Then I want to make money below there, right? That's an example. That 10% node, at what time? Maybe it's a month out, maybe it's a year out. That is a moment of a full distribution, and it's priced based on the probabilities of its outcome. Okay.
And so if you're in the business of selling that insurance, obviously, like you're
a vol seller.
Well, if you're just to use like a real world example, if you are in the business of selling fire and earthquake insurance, it is in your best interest that no fires and no earthquakes happen.
Low volatility, right? You want low volatility. You want the world to just time to pass and nothing to happen.
Exactly. So if you are in this low liquidity environment where things are just kind of humming along, and month after month, these banks, these as you would call them dealers, because again, an interchangeable vocabulary. Dealers, when you refer to dealers, you are referring to the banks, J.P. Morgan, Bank of America,
and the market makers. But yes,
and the market makers. They are in the business of, hey, volatility's low right now, but hey, you never know. I mean, they're not literally doing this, but hey, you never know. You might want to take some insurance because you never know when a fire or an earthquake's going to happen. So I'm selling out insurance. And so to hedge my position as the insurer, it is in my best interest to use the powers that I've got, the liquidity access that I've got, the cash that I've got in the market to keep those prices from reaching those breaking points.
That's not why they're doing it, by the way. They're making tons of fees by selling these things. Exactly. That's why they're doing it, okay? They make a ton of money, not because they want vol compressed, by the way. That's not why they issue structured product. They do it because it's profitable, and because they can sell a ton. And by the way, they get stuck with the long volatility, right, when the structured product issuers sell it. And they don't want to be long the volatility either, because the volatility tends to lose money over time because there's a risk premium. So they go sell it back to go neutral to dealers or market makers, other dealers, and maybe they hold some of it, and maybe they have other, short volatility exposure they get by issuing other things to offset themselves. But the banks really want to be neutral. They want to play both sides. They want to be the casino, right? And so at the end of the day, this creates a race to the bottom. When there's one steady dominant seller and that amount has grown and the volumes are low in the summer, the vol just will go lower and lower because there's just more and more supply. Now, importantly, I want to make sure we understand this part. As market makers and dealers, at some point, somebody has to hold the hot potato, right? Like that vol has to be warehoused somewhere. At some point, people are like, well, I'll hold it and I'll scalp it, right? Because the other way to make money on this is not for just somebody to buy the vol from you at a higher price. It's for some volatility to actually transpire and for you to capture the profit from that volatility happening. So if I am long, let's say, a straddle, which is the most basic kind of vol, which is long a call and long a put at the money, right? Let's say in the S&P 500, we're saying trading 6,300, and I have a 6,300 call and a 6,300 put a
You
week
want
out.
the market to stay at 6,300.
No, I'm long it, so I don't want it to stay at 6,300. I'm the one who's got stuck long it, and let's say it's $50. You're like, well, I guess at this point for $50, I'll own it because I think we'll move $50 in the next week. Well, now your job is to scalp any decline that happens and any rally that happens to try and capture the volatility itself. Well, if vol is very low and the market is warehousing a bunch of risk, a bunch of vol, and the dealers are stuck long, what are they going to do? Well, the market goes down, they're going to buy it. Market goes up, they're going to sell it. And then you get a reflexive loop where vol itself, implied vol being low, insurance being laid in on the market with no volume happening, itself having a reflexive effect of pitting the market. So even though we call it insurance, the difference is the insurance issuance itself doesn't affect whether a tornado or a fire happens. But in this situation, because supply that we're dealing with a market itself and the supply and demand is what is the outcome we're hedging, the vol issuance is actually reflexively causing low volatility. And that's a hard thing for people to comprehend. You are not just betting on an outcome that is unconnected, from the actual contracts insurance you're buying. It is a reflexive loop where low volatility begets lower volatility, lower implied volatility begets lower realized volatility. And so actually, ironically, most people think, oh, a low VIX, you want to buy a low VIX. And a high VIX, you want to sell a high VIX. That's what people think because it's mean reverting. No, actually for the majority from about 27 or 25 down to 0, right, which is the majority of VIX outcomes, or down to 10, whatever the low 8 vol, that outcome, the lower you go historically on vol, the more profitable vol selling is. The more profitable the realized difference is between volatility and the actual outcome. And that is for exactly the same reasons. The lower vol goes, the less likely these outcomes are to happen. And you could argue, well, vol is low because people know something's not going to happen. But it's actually the fact that vol itself is supply that pins the market and makes it less likely. And I can talk through all the historical stories. 2017 is a outlier in history. I think we might have talked about on here. It is the lowest realized and implied volatility by more than 30% of any other year in 125 years of history. It's a total outlier in history.
Jesus.
Yeah.
There was just so much insurance out there. Because basically, from what I understand, like you've said before, if everybody and their mom is insured and ready for the drop, the less likely that drop is to happen.
Because the market is supply and demand.
Yeah.
Positioning is the most important thing. That's the point I'm trying to make here, both with structured products and in hedge funds. Positioning has gotten so large that the potential energy, the potential supply and demand that's in the marketplace is all vol compression and all long short equity and short things that are expensive and long things that are cheap. And you put that massive positioning together and then nobody's trading anymore except a couple guys. What do you think is going to happen? Well, the people who are short are demand and weight. The people who are long are supply and weight, right? And everybody's long vol, so there's just more vol to sell. So you get into a loop of vol compression, and the connection between the two is all of the vol compression is happening at the index level. And if the index is compressed, the more compressed the index is, there is still idiosyncratic vol. There is still NVIDIA goes up because it has great earnings. And Donald Trump says something about, copper, and copper stocks move. So those things still matter, and those aren't vol centers. But if the index is pinned, as we've seen, doesn't all the macro, it's it just rolls off, right? Doesn't even matter to the index. But underneath the hood, you're getting massive rotations because those things still have to move, which means something has to move the other way. So that effect is how these two massive growth and positioning are connected. The index vol is being compressed. Dispersion is happening. Things are being forced. It's like a reverse magnet. Things are being forced away from each other on the single list name. And the potential energy, the supply and demand that's getting squeezed is the massive long-short equity positioning. And we can see that through the momentum value factor rotation that we're seeing that's almost identical this summer to what was last summer, but actually exaggerated. And it's actually worse this year than last year, not only because the sizes of both these things have increased again another year, but this year actually hedge funds got caught underweight stock, under allocated equities because of the decline, because of the macro issues. And by the way, that's logical, much like their other bets are logical, right? But you go into a summer and the vol compression, and all of a sudden the pain trade is not just hitting them on long short, but it's also hitting them on the squeeze in the market as well. And so the actual squeeze higher in the market is largely driven by hedge fund pain. And that's the big point I'm making. This is a hedge fund squeeze. You can see it underneath the hood. By the way, squeezes can lead to more rallies. That's you could argue that's what the tech bubble final leg was. A lot of these blow off tops happen, by the way, and this is the other connection that you can make here. Final blow off tops and big macro declines happen because people are getting short, institutions are getting short. Logically, the worse the news gets, the more the weighing machine weighs on these people's heads and says, look, this is crazy. We have to get less long equities. We need to be less long. We need to go more non-correlated. The more under-allocated they are, the more short they are. That is potential demand in weight. And they can be squeezed.
They get squeezed.
And in the short-term markets are a voting machine. In the long term, they're a weighing machine. And so that voting machine becomes more short relative to long. And now it has the potential to really squeeze. And usually, not usually, about 50% of the time, and again, it's illogical, you get a blow off top before a big decline. And that's a big reason for why. That paired with the vol compression, the von Charm flows we talk about, that the structural effects that then squeeze the relative shorts, force them back in, right? Because they have to ultimately be measured by a shorter time frame than 2, 3, 4 years. They have to be measured to quarters, years at the very least, if not months. And they are forced to delever. And so there's a lot of deleverage going on at the hedge fund level right now. And there is the potential for a blow off top as a result. But we can get to kind of the predictions and kind of what we see and the timing of those things here.
Yeah, I just speaking of blow off tops, who's getting blow off? Emil's already ready. That guy who sold all that Bitcoin, man, he's getting some blow off top this
weekend.
weekend.
He's having a whole weekend of blow off topping.
But wait, so I wanted to ask you, Emil, does this all make sense to you? Because you're a little bit more of a layman, a layperson. I wonder if you've got any questions.
A lot of it's difficult for me, but it's definitely making more sense.
Yeah, that's what I've learned through watching Jim. Is the more you listen, the more you pay. Yeah. It's Do you have any questions? I'm sorry.
Yeah, do you have any questions? Want to dive in?
I do have questions about the blow off top thing you're talking about. Is that something that you think? It sounds like you think that's where we're heading, right? A blow off top and then a longer decline.
I want to be clear. Everybody wants a 2-dimensional prediction, right? What's going to happen in next week? There is a distribution of outcomes. Certain paths are dramatically more likely. That's what I'm trying to highlight. There's a dramatic value to knowing what paths are more likely. It is much easier to predict distribution, right, than it is to predict up-down. And to some people, that sounds like a cop-out. Everybody's like, well, you said up and then that's down. Like, no. Understanding how the machine works and what the likely outcomes, if this, given that, I can tell you what is likely to happen if this, given that. And I can tell you where this is likely to go if certain things happen. We're going to walk through that whole path. But that is more complicated than saying, are we going up or going down? And we are at a fork that's very important in the road right now, really in the next month or two, right? That is going to determine one of two very likely paths. And one is a blow off top, right? And the other one is a boil the frog, slow decline at first. That's kind of starts kind of rolling over slowly. Kind of think 2022 before kind of accelerating next year, early next year. But a lot of that timing has to do with geopolitics. It has to do with the CPI numbers and the data and everything that we're seeing, the tariffs, the political cycle. All of these things are part of that timing. And the more we get through the calendar here, and then get into those dynamics if you'd like, the odds of one will become more dominant than the other. Summer of George will resolve here. It did resolve.
It does sound like maybe with those two options, though, Trump might label you a card-carrying member of the Panikins.
I am not a Panikin. I am no, the reality is, unless we can, there are structural issues. The weighing machine is not going to change. Those things matter over 4 years, 5 years, 10 years, right? We can talk about, and I've been talking for 5 years about these things, and those things are happening. You can, all of the things are happening. But the reality is, in between there are structural flows, there's positioning, and there are outcomes that lead us, on a path that then is then affected by ultimately this weighing machine along with other effects. And so we put them all together. We model distributions daily, weekly, monthly, quarterly, annually, 5-year out. And in the short term, it's simply buyers and sellers. In the long term, it is an outcome, and those two things meet in the middle. And as a result, we have several different possible outcomes in the next, I would say, 6 months to 9 months. And one of the biggest parts of that is not just the weighing machine, but the midterms that are coming at the other end of it, the Federal Reserve chairmanship rolling over next June, and the incentives of the political structures in place when paired with that big kind of structural interest rate valuation earnings story that we see happening.
You alluded to a little bit, but I don't know if we have any hard outs. I know a lot of people tune in for some peering into the crystal ball, so I want to make sure we don't.
Yeah, we should. We're on the home stretch.
Yeah, okay.
What do you got?
No. I thought.
Oh yeah,
let's do it. Let's get more specific. Yeah, I'm with you. Let's do it. So here's the deal. We'll start from long term to short term because it's kind of the more logical kind of progression here. We know that on all these measures of whether or not it's worth it for institutions to own equities and to own bonds, to be 60-40 allocated, to buy assets, that we are at or near historic valuations. Okay, so let's start there. We know that at the same time that the releveraging, the amount of money that was created in 2021 that drove a lot of this investment, right? Its peak of reissuance of debt and all these other things happened in 2021. The amount of reinvestment, so as debt rolls off, you either have to get new debt or you have to liquidate the asset that you bought with that debt, right? Those are your two options at that point. And the rates that people got, think about 1.5% back then, are now 5%, 5.5%, 6%, maybe 7%, some mortgage, right? And the reality is that money people have to make that decision. There's a massive amount of reissuance that needs to happen in order to meet that. And when everybody needs to go get a mortgage or a loan or whatever, that is liquidity coming out of the system. You have cash, which is money, and you have debt, which is money. Debt has an expiration date. When that debt expires, that liquidity comes out of the world. You either have to sell the asset, right? Or you got to go get you need to spend money to go get a new bond. And now the cost of that has gone way up. And it's not just bonds, it's venture capital, it's all the things, right? Like SPACs were a great example, right? All the venture capital, companies raised dramatic amount of money back then. So that money is coming due, and the average duration of that debt and that is 5 to 7 years, and that venture capital money is 5 to 7 years. That puts us at 2026, right, to 2028 as the peak, and it's already starting, right? So all of that money, these are the things we know, right, has to be pulled off, and this is why Trump is talking about Powell constantly. He's obsessed about it. That's why best on him keep talking about the 10-year. At the end of the day, that liquidity and where it stands now, if it just stays there, and by the way, if markets are supply and demand, if everybody needs to come essentially, get more debt, what do you think is going to happen to the price of that debt? Right? If everybody needs to get through the same door at the same time, there's not a lot of liquidity. Yeah, yields are going to fucking go higher, right? So this is a problem. This is a problem for the market. It's a problem for Trump. And by the way, Trump has midterms coming up in 2 years. Right? His popularity is already not so great because of some of these things. So he has a dance to do. The politicians always have to do a dance. And the timing of that dance is very important. Yeah, they got to do the dance. I need my shoulder pads.
His YMCA.
Yeah, his YMCA dance. Yeah, he's got to do a dance. And the timing of that dance, as awkward as it may seem, has to be to the beat. And that beat is the election cycle. So you could have the market go down this year, but it better be going up next year. Because if it's not going up next year, then you're going to lose Congress and you're going to lose power. Right?
I mind if a white boy does a little dance.
But how can we be sure if it goes down next year, that's not just Biden's economy, you know?
Well, he can call it, it's easy to call it. That's the other thing. It's easy to call it Biden's economy this year. Not easy to call it Biden's economy next year. And by the way, if it goes down, he will call it Biden's economy. That doesn't mean people will buy it or be happy about the situation. So the point here is, in order for the Fed to stimulate, and in order for them to get a market going up into the midterms, right, and be resolving issues, they would want any issue to come sooner, not later, right? And by the way, a little issue now, and this is that's what April was about. They really wanted the market to come down so they could get the Fed to stimulate, to get the liquidity going, but it didn't go quite as planned, right? And they had to pull a UE real quick because it looked more dangerous. That said, a controlled demolition is very much in the interest, particularly in the economy without the market imploding, right, is in the interest of the administration. If they can get that, then they can get more cuts. And then in May, June, when they get the chairmanship, pretty easy to be like, okay, we're going to go Arthur Burns and drop this thing 2, 3, 4%, right? And you better believe markets will respond to that. Now, that doesn't end well because all the valuations and that refinancing and everything else we talked about, by the way, the 10-year, they can't really control the 10-year, or if they do, there's all kinds of issues if they do Project Twist. We'll get to that in a second. But the point is there's no real way out of the big picture problem, which is populism and protectionism are stagflationary, right? They create higher tariff costs. They create lower profit margins. They are a tax on the consumer. They create less demand. All the things we know. And by the way, the only way out is for Trump to say, we're not doing tariffs anymore. It was a joke. We're not going to actually do it. And then he doesn't get reelected because his base is populist. But we're opening up the borders again. We got labor supply back. Like, no, he can't do that. That's against his political, like who he is and why he's come to power. And so the point here is the big picture things are still in place. And those big things are stagflationary. They are a problem for the valuation of markets. They are bad for the long end of the curve in terms of bonds, bad for inflation. That's not going away. And given that, though, we can play the dance. He can play the dance in between and get markets to squeeze into the midterms, and they're going to try. And they have the power to do it now, and they have the power to make that happen even more so by middle of next year. If they get a slowdown in the economy, which they're starting to see, and they will, I think, and they will even have more ability to argue that they need to do that. So this is the big picture. There's a 5-10 year picture, which is the macro rates higher, stagflationary environment driven by populism, protectionism. We've talked about this. We can do another show all on that again and really get into the big picture and why. Yeah, but please. That has been true for 5 years. That will be true for another 5 to 10 years. It is driven by demographics and the fact that millennials on down are stuck in mom and dad's basement and have a 40 to 45% of the wealth creation, household formation, the baby boomers at this time, and they are coming to political dominance. They are driving both on the left and right, left outcomes, tariffs, populism, protectionism, fairness, not free market economics.
Yeah, you and Rick Santelli were actually talking about this in your interview, and it was a little bit scary because it seemed like you guys were kind of. I think you asked him maybe his what his solution would kind of be, and it almost seemed like both of you kind of. Maybe I read it wrong. That you kind of came to the conclusion that like there's kind of no way out of it without a crisis, maybe, or something like that.
That's absolutely true, and it's not because you can't borrow from the future. And then say, we're not going to pay it back. And I'm not talking about debt, by the way, when I say borrow for the future. We created this massive inequality, the cost, right, of the no inflation, low inflation, deflationary boom in assets was giving money to the rich and taking it from the poor.
Well, yeah, I mean, they're the job creators.
Who else are we going to give it
Who
to?
else
I'm
are we
not
gonna
saying
give
it's,
it to?
No,
I'm not
I'm
saying
just-
it's wrong or right. That's a political argument. Socrates would say, give the best violin players the best violins. That's free market economics. That creates infinitely beautiful music. The idea here is free market economics creates faster, better technologies. It creates more advancement, higher efficiency and
More
growth.
structured products.
Hedge funds.
Structured products, Daddy.
But what it also does is it makes kings and queens and slaves. And the reality is the free market is not fair. It is raw in tooth and claw. So evolution means that there is one winner, the healthiest, most fit, right? And that is a natural system. Unfortunately, we as humans don't believe, not unfortunately, that we don't believe that we believe in this concept called fairness, like justice, and the reality is if we want to have a free and just system, eventually inequality and free market economics is a problem. We need to exert order on a natural system in order to make things more fair. Anyway, so this is going to be a whole other podcast, but the point here is that reality, once we've gone to the natural pendulum swinging extreme of dramatic inequality, and we are there, the only way to fix inequality is to redistribute wealth, to create structures that allow the poor to rebuild the middle class, right? To take from the super rich, the kings and queens, and redistribute money. And that's not good for markets. That's not good for investment assets. That's not good for globalization. That's not good for technological development. And that's what I'm trying to say. Now, I'm not saying that's bad. The reality is it may be bad for our stocks. We need to disconnect the idea that stocks and the performance of assets is what matters to human beings, right? It's what matters to you and I. And if we're in the top 1%, that's what matters, right?
Sure, it's like the conflation of the stock market is the economy for a lot of
Stock
people.
market is the economy for the top 1%. It's not the economy for the bottom 50%, that's for sure. And so that's the core. And this is why revolutions happen. This is a story as old as time. And this is why cycles happen. Okay. So, but we were going to do the crumbs and the crystal ball on them. We're talking 10 years, right? And the reality is the 10-year outlook, no bueno. Okay. Things are super expensive. It's one thing for things to be expensive in general. It's another thing for them to be expensive right as, the angry hordes and the generations that need inequality are coming for a less efficient system and rising interest rates. Rising interest rates, the worst thing for assets. It's the most important thing for long-term valuations of assets, right as we're at record. So the 10-year look is not pretty. And by the way, that puts Donald Trump and any administration in a bit of a pickle, because politically they're subject to the needs and desires of the electorate, which is increasingly populist, but they are also subject to capital and what's happening in markets and what that does to sentiment, et cetera. So political cycle really matters. We talked about this last year a lot, 1968 to 1982. Interestingly, actually 64 to 82, it's almost 20-year period. The average president was in term for 4.1 years. Okay. There was only one president who got reelected, and that was Nixon. And he got, pulled out of office soon after. That's not a coincidence. During populist times, there is this very much people unhappy. The electorate wants change. They want to burn it down. See the flames behind me here, right? They want to burn it down. And the burn it down philosophy drives people. The second they elect one person, about 3 years later, they're like, this guy sucks too. I want the next one change. It's about change. By the way, contrast that to the last 30, 40 years, we've had an average of 7.1. And most presidents, because they have power, are able to get a second term. And so this is a time of, it's very difficult for presidents to remain in power, and they need to pull all the levers, think Nixon, to try and make it happen. There is a reason that Trump rhymes with Nixon. Nixon was a Republican during a Democratic populist period, right? And he was we're going to break things, we're going to burn it down president. And he was also willing to do whatever he had to do to make that happen. Those type of people are kind of what come to power eventually in this cycle. The problem is eventually they get seen as just as corrupt or even more corrupt, right? Ultimately, and the hordes come for them as well, as we saw with Watergate. And they ultimately also get tied back into the reality that I just said, that they cannot control the circumstances. They are just in a bad time. So what does that mean for the crystal ball?
Yeah, I was just going to say we should wrap up here. We're just running out of time, but can you give us the crystal ball for the next, like, going into August OPEX or whatever you see for the next quarter, whatever timeline you want to.
So last summer we had the hedge fund delevering, which is kind of the supply and demand story, right? But it's even worse this year because of the under leverage to equities, to the short interest from hedge funds. So they're getting pushed in two directions. They're being forced to delever and buy back into the market. And when volumes are low, that is the dominant force. Okay. But at some point, as we saw at VIX last summer, right, the Vonage harm flows from the vol compression slow. The amount of short interest has been taken down because hedge funds are getting hurt and they have to kind of delever. And at some point, they don't need to delever much anymore. And at some point, the vol compression, which has been driven by the Vonage harm flows and the vol compression, also starts to dissipate. And if that happens, which usually happens either at July expiration or August expiration, historically it's more August. Last year was July, but some of these dynamics are being accelerated these days. At that point, when vol on the back of the curve starts to kind of come back alive and volumes start to come back up, and hedge fund pain, which has been driving the rally, starts to dissipate, you can actually have a situation where the market kind of declines, maybe slowly at first, usually slowly at first, because it's been easy to hedge, and then eventually kind of releases, right? And a lot of the kind of longer term structural realities come back into line, right? And so the summers are this really placid time that the macro diverges from reality just as a function of structural flows. But eventually, my point is, those things do come back into line. What is likely, because of the dance, the political dance now, those are the flows that are happening now. We just got to today's expiration itself, coming into this quote unquote window of weakness where these Von and charm flows, the supportive flows that come from vol compression, which we could dive into more at some point, come off the table. Now there's less supportive flows. Short interest from hedge funds has come down a bit, a little bit of a decline where hedge funds slowly take off that exposure. Retail still tries to buy the dip and continues to buy the dip because it's been working, and this doesn't feel, think about 22. 22 is the most painful period for retail because 21 happened and everybody's bullish and buying the dip was so great. And if you boil the frog, very slowly take things down, they continue to buy the dip, buy the dip, buy the dip. They bought the dip 27% lower in 22, right? Whereas if it's a quick vol down, then they're like, okay, I get a chance to buy it with leverage now, and then the Von and charm flows come in. That's the other part. If the vol goes up, then you can get a V bottom. But if you don't get a real vol expansion ever into a decline,
right,
it's very hard to get that reaction back. So the most likely outcome is still a normalization of what's been caused by kind of supply and demand imbalances in the market. Given where we are in the expiration cycle, that's more likely. Given the amount of squeeze we've had and how positioning has changed, given where sentiment is, you can go look at sentiment indicators. They're super hot. Across the board, there's, again, the momentum value factor ratio, which you can take a look at, will also, that all dramatically leads the market. Those two things are major jaws right now. That's what happened last summer as well. And again, that shows that pain underneath the surface. Lastly, I'll say we are on day 60 trading days, where we have closed above the 20-day moving average of the S&P 500. When the last time that happened, that consistent amount of rally happened?
2021?
1999.
1999.
That is the longest time to close above the 20-day moving average consistently. That summer of George action, that is driven by the supply and demand, low leverage. It is unhealthy. It is a reaction, right, to structural supply and demand forces that have nothing to do with macro. And so the reality is at some point, we're going to break the 20-day. It's not that far away, right? And this vol compression, which has driven this short squeeze, will resolve itself. I don't think this time we're going to have a vol event. And by the way, we didn't have a vol event first until August anyway, because vol is still relatively well supplied. But that boiling the pot with the frog in it very slowly will be the most likely outcome to actually have a continuation of that decline once it resolves. Because the second hedge funds aren't short anymore, right? Then there's no more demand underneath the surface. The second retail continues to keep buying on the dip, right? Eventually that becomes a problem. And so as we enter the fall, this is why September tends to be this very stressful month, because you come out of the summer of vol compression and natural forces releasing from a very low vol, and then vol can release, and then you get these kind of events. Okay, so I don't think there's going to be a big vol event, but I do think we are going to get, and particularly don't think there's going to be a vol event because we just had one. There's a long history of the second vol itself has performed really well. People are better hedged, and it doesn't mean we don't get a decline, but the next decline tends to be a low vol, longer, slower, stair-step, market down, vol down currents. But I do think there's a very high probability. The highest path is some type of very slow at first, 1 month, think 2.5 to 5% decline, very slow. And you get to August, and then maybe you get, and by the way, that'll be like stair steps. There'll be some decent drops, rallies, whatever. Get to August into Sep, that's the big cycle. The Sep skew is still really high. A lot of structured products with lots of tail exposure underneath the hood in September. Vol can start to expand because now we're getting into the fall. And then you could get a 5 to 7.5, still something not crazy. But then you look back, it's been a 2-month, 10 to 12.5% decline. We're into mid-September, Sep OPEX, and then there will be an attempt to rally.
Gotcha.
And we'll see at that point. We'll be on before then. But if this all happens, and that's the more likely outcome, then we'll start to see a rally. And then people start talking about November, December, end of the year, blow off top. Here we go. Retail, all in. And institutions, we'll see where institutions are. But institutions are likely then to also not only be short, but really to be, to start turning long. And that can be an exact time where if you can't get the momentum you need, and sentiment is generally positive into that decline. And by the way, we're going to get so much macro information in the next 2 months. It is what we've actually been waiting for now throughout the summer. All the inflation data, the earnings data right now is so important, more to profit margins than anything, because of tariffs and their effects on them. Inflation numbers, all of this stuff is so important. So as that information comes through, we'll have a lot more data about, okay, what's actually happening for the multi-year outcome. We'll have a lot more information about kind of where positioning is coming out of the next month or two. And if we do get this decline, then we'll have a good look at October to kind of try and make a call. Okay, is this a viable dip or not? I will say, if we do not actually get this decline, which I think is the most likely, is by no means a given, right? There's all kinds of effects that are structurally positive in markets. Vol is still very compressed. Hedge funds are still getting hurt, right? All those things are still true. But if we go another month here without some sideways, slightly down action, right, that boiling the pot action, we start to get closer into this magnifying glass that is the end of the year. There is a re-leveraging effect that is so important for the end of the year. What do I mean by that? And this is the last thing I'll say before we kind of part ways here. In the end of the year, the seasonality that drives both the Santa Claus effect and the January effect, the most positive month in history, over the long term, by far the most positive month in risk reward is the last 2 weeks of the year, first 2 weeks of the year. Why? Not because of Santa Claus. It's because the whole market is built on leverage. Most money is leverage, right? If the market is, let's say, 50% leverage, right? And the market is up 10%, it's a $200 trillion market, right? So we make 10% on $200 trillion, market goes up. You have $20 trillion more money to invest. If it's 50-50 leverage, you have 10 trillion, right? So there's a re-leveraging, reinvestment effect that happens when the market's up. It actually happens at baseline because at 5% interest, people make money, companies make money, and they need to reinvest. And not all of that happens Jan 1, to be clear. It happens throughout the year. It happens on monthly. It happens on quarterly. But a certain amount of the slower moving private equity money, venture capital money, funds start January 1st. And so that new money investment that comes in at baseline with market sideways is very powerful and concentrated right in that period. And nobody's going to, supply and demand. If you have $5 trillion coming in Jan 1, the first week of Jan 1, it gets front run in the end of December. And then, rode into the middle of January. Importantly, though, where the market is, and this is the part most people don't understand. People just think, oh, the end of the year is positive. I want to be long. End of the year is very positive if the markets are up. If it's sideways, it's slightly positive. If it's down, it's negative.
Yeah.
And so if we get going into a slow decline here into September, we can't respond in October, you could see a 2018 type October, November, December 19% decline. Those things can happen, and they tend to happen when the market's down. And the more you get towards that period, and it's low liquidity and it's already into a decline, again, it doesn't have to be a massive liquidation. By the way, October, November, December 2018, that 19% decline was the same boiling the pot scenario where market just kind of dripped for 3 months. Vol didn't explode. Right? So that is how a decline would, if it's going to happen, would happen. That is the path. We're not talking about big vol event. We're not happening. You're not talking about, by the way, if a big vol event happens, I'm not as bearish, because then you have that vol expansion and then you get a big rally back and then you get into the end of the year and then, okay, we're right back to kind of where we were. Okay. So this is how a decline would happen. I want to be clear. If it does not start to happen by August, early August, mid-August, let's say, and let's say markets are higher by mid to late August, you're kind of running out of, that dance that the administration's doing is sitting over in next year, right? And that end of the year magnifying glass is sitting out there at the end of the year. Right? And so then you can start to really see the machinations of the market go into effect and start squeezing, right?
Gotcha.
And so that would be, let's see where things are a month, 2 months from now. The next 2 months plus all the data is important. If the data just is more positive, the tariffs are truly not in effect, I'm skeptical. But that would be something that's very important for the bigger picture, and then could also drive sentiment and 10-year kind of relief, et cetera. So that's the summer. That's where we are.
Beautiful.
Be water, I guess, as I say. We're at a fork. We're
hotter
we're
than
at a,
hell in here. God damn.
there are flames behind me. It's hot in here.
Yeah, you're hotter. You're hot too. Well, Jim, thank you so much as always. It's always a pleasure. I learn something every single time, and yeah, we'll coordinate with having you on our show to talk more macro stuff and I don't know, conspiracies and whatnot, because it's always fun.
Appreciate it always. We wish everyone in these stressful times some blow off top this weekend.
Yeah.
We really hope everyone
be safe out there,
have a great
everybody.
weekend.
Everybody's cheering for the blow off top. I think that's what everybody wants.
Thank you, Jim.
Have a good one, guys.
Everybody, see you next week.
Chat soon. Later, guys.